This is Randy Finney with Right Side of the Chart, and today is Wednesday, September 21st, 2022, aka Fed Day. So at 2 p.m. today, we'll have the FOMC announcement, rate announcement. Pretty much 3/4 a point seems to be baked in the cake, with a decent but much lower chance of a full percentage point. You remember, it's so here's how it works. Well, first of all, the market's reaction is the most important thing, and not the immediate reaction. I say this over and over. The immediate reaction at 2 p.m. is often a knee-jerk reaction, and there's even volatility. Powell come on and start doing his press conference at 2:30, and so, best to keep things light, or not, at least not read too much into any breakouts, breaks of support, breaks above resistance until after that. What I tend to do is layer in and layer out. I've been lightening up on my trades yesterday. I told you guys I'd be out, probably take the rest of the day off. I did have a roofing contractor come by yesterday. We spent quite a bit of time. So, and I came in, I did just a couple hit and run trades. All good, just trading NQs back and forth. But what I'm going to do is, so I've tapered down, frequency and position sizes of those trades, and then I'll do it the other way on the way out. Here, let me try to give you a visual of what I'm talking about. This is called a damped sine wave, and what that is, it's a sine wave with decreasing amplitude. So you can see it, it's getting smaller and smaller and smaller, and so that's typically what I'll do, with trades and position size approaching the Fed meeting. And then on the way out, I'll do it in reverse. In other words, since there's always a chance you get a whipsaw, the market may whip one way, give you a buy or sell signal, and go the other. But over time, in other words, Thursday will know better than this afternoon. Friday will know better than Thursday. Especially going into next week, we'll have a much clearer idea, or we should, of which way the markets are going to go, and then I'll start stacking in or increasing those positions, and mainly in the market, but everything's tied together as I talk about commodities, oil, natural gas. To me, it is all intertwined. I'm going to talk about some trade ideas, do updates on the markets. Treasury bonds I'm really liking. Let's get into that real quick. So remember, the weekly charts of the equity markets, I'm focusing here on QQQ, but SPY is similar. They look like death. They're not good. We're in a bear market. And below the 200 days, below the primary trend line, everything I've covered recently. I don't want to rehash too much of the same stuff over and over. And if I could only look at this chart, I would say there's a very, very strong chance, and I still think it's a very good chance, that we're going to, just after the Fed come on down, have a pretty sharp sell-off, and then move down to hit my next and final, what I'm calling final initial bear market target on the Qs. If that's confusing, because I do think over time we're going to go quite a bit lower. I think we're looking at a multi-year bear market, most likely, not a quick one and done. The last bear market, in my opinion, was the October 2007 to March 2009. So that one was about a year and a half. And as painful as it was, a 55% drop in both the NASDAQ and the S&P, if you tucked your head in the sand, and just didn't do nothing, froze like a deer in the headlights, held onto your 401k and stocks, if you didn't, you weren't actively trading or reading the charts back at the time, it was extremely profitable bear market for me to trade, both long and short. But, those that, don't know technical analysis probably wrote it out. And if you did, guess what? Before it was over, before you knew it, it was over. The markets exploded higher after '09, and then went on to recoup all those losses and then some. This one I think is going to unfold a little differently. So, once we hit this target, I think there'll be a nice tradable rally. Swing trend tradable, like 401k kind of stuff, where you move your money back into equity markets. But then ultimately, because and not the only reason, but part of the reason for that, it's just the technicals, and the fundamentals. We're coming off one of the biggest bubbles ever blown in history by the central banks, and we're also coming off, as I'll talk about when I get into bonds again, we're coming off we've already pretty much, it looks like we've ended a secular bear market in interest rates that started way back in the early 1980s when interest rates peaked. And you can overlay the charts of the stock market interest rates, or if you Economics 101, you know that falling interest rates are good for the stock market and good for stocks, whereas rising interest rates are bad for the stock market and stocks. So therefore, this is not, in my opinion, going to be another 2000 to 2002 or 2007 to 2009. These are what we call cyclical bear markets within a secular or larger bull market, right? And so we're in a cyclical bear market now. There's no arguing that. We've already hit at least the basic metric of 20% drop. But once we take out this long-term uptrend line, we've already taken out that my 20-week moving average, 20-month moving average, and we take out this primary bull market uptrend line that's going to have longer-term bearish implications and probably send us much lower. And if and when we hit my fourth target, we're going to be below that. Now we'll have to watch that month. Maybe we hit my T4 level, which is about right here, and then explode back up and only to close the month back on or above that and not give us a confirming sell signal. Confirming candle would be a monthly, a red candle that closes well clearly below that uptrend line. So what do we have? 10 days to go here, 9 days in September. Well, so we'll see where this month closes. However, all right, so that is kind of bigger picture stuff. Daily chart doesn't look so hot either. I don't have divergences, things I'd like to see. There is a little RSI divergence actually, but that's about it. And we're not at support. I really like to see for a strong evidence for a bear market rally, just like that right there was that tag, that perfect tag of the third target, T3, on my weekly chart, and we got that rally, and we covered, or I posted covering all last of the shorts and starting to go long there for swing and trend positions, targeting this bounce target zone. And so that was a better long opportunity. Right now, I'm going to go what I've been doing for recently, making the case that although I cannot make a very strong case because I don't have any solid support here on the daily charts that we're at, or even weekly charts. I do, on the other hand, have nice positive divergences on the 60-minute time frames. I'm looking, and cryptos also look bullish with some divergences, and cryptos are actually at support. So if you want to know, again, and I said it the other day, I suspect what's going to happen is the Fed is going to either explicitly or implicitly signal to the markets that they're backing off a little bit. And this is again just a hunch. My hunch, I think it's going to come from something on quantitative, the QT side of things, the quantitative tightening, because the bond market's about to break the entire global economy and U.S. economy. So I think they're going to do something there, probably cut back on their the runoff on the balance sheet there. That would be my guess. And they're going to give you a 3/4 point. They're going to talk the tough talk like they did. But again, if the market senses any weakness or any backing off on any aspect, whether it's the federal funds rate or the quantitative tightening part, again, whether it's explicit or implicit, that's where I think you have the case for a near-term rally. So it could play out like this. If these divergences play out, you still have this downtrend line off the highs right here. We're on a 60-minute chart, by the way, on QQQ. So we could shoot up here, rally up there. You have intersecting price resistance and downtrend line resistance, roughly, approximately, if and when we get there, we'll say that's only about 2.5 to 3% above where we are. You also have these longer term downtrend lines both on QQQ and SPY. Remember those we hit recently. Here's SPY right here, 60-minute chart. There's my lines. So that we hit it once. We've hit it a couple times. This is our primary bear market downtrend line, the S&P 500. There's the January early beginning of the year highs right there. That was the multi-year. That was the peak of the S&P 500 all-time high. So that's when the bear market started, and that's where we had our last get out of longs, back into swing shorts right there. That bearish rising wedge rallied right into resistance, trendline resistance. QQQs also hit the bounce target zone. The S&P 500 made a perfect run at the 200-day simple moving average, and that was that. And there we are. So we've been we've been trading this thing down long and short as an active trader. Or if you're, like I said, if you're not an active trader, just a trend trader, that's where you should have got out of any longs and into shorts. And as of now, we don't have buy signals, but we do have, like I said, for the first time since back here, or right here really, nice positive divergences. And these divergences now, we zoom in nice and tight on the S&P here, they're just an extension. We had these divergent, we had a divergent low there. Really only on the, no, not even, that was just a wedge. This was our divergent low right there. That's where we had, see, that's where the positive divergence started right there. And this is just an extension of that divergence, which would imply potentially an even bigger rally. But we're in a bear market, so you got a lot of resistance levels overhead that the sellers are likely to step in. What should get the market going? If they can pop 390. See, this is big. It was big support right there. We gap below it. We've been popping in this range here. Bulls want to see a pop above 390. Then you'll probably get a rejection off the initial back test of that trend line. But if we can clear that, I'm trying to give you an arrow tool here. If I can click on it, there's, see, these are all your potential bounce targets. Now, I'm sitting here talking about, okay, if these 60-minute divergences play out, as I suspect that they might, I suspect that they will. Again, I'm not going to bet the farm on it. I'll layer into it if and as that, once the Fed's out of the way, if that's where things are going, and I'll do it strategically. What does that mean? Well, on breakouts above resistance and or pullback to supports. Those are strategic entries. Otherwise, you can just blind, buy. I don't like blind buying or selling. It's just not my style. All right, so that's that. There's support. And so what would be the bearish case? Well, we have this recent trading range right here. Let me give my box tool. All right, so we broke down that big support level. Remember, that was big support right there. Broke down. We've been bouncing in between there, waiting for the Fed. This is why that whole decreasing amount of trades and position size, because you get in there, it's a very tradable market. I've batted 1,000 the last few days. In fact, I can't even remember last time out of well over a dozen trades on the NQ that I even had one miss. But they're getting smaller and smaller, and then we're going to explode out of here one way or another. This market is either going to, after the Fed's over, probably rally pretty good, or if we crap out. And what do you look for? Well, obviously a break of the recent lows, anything other than just a brief whipsaw. Remember, you're going to get the noise after the Fed. But then if you start to take out these divergences, you have support here about 373. That's pretty much the last stand for the S&P right there. There is, of course, always a previous low, but I think if we take that out, it's just going to be a knife through the heart of the bulls. You'll see a lot of panic selling, capitulation type selling. So yeah, I'm telling you things are going to go either way, and I'm telling you I don't have the highest degree of confidence, so I'm leaning towards this upside, but I will certainly not position heavy or stay long if that's the case. And if I think it's going to go this way, I'll flip on a dime. That's me. I am neither bull or bear, perma bull, perma bear. I am whatever it is at the moment I need to be. That's how I trade the market. I'm completely, like I said, market agnostic. I'll take the charts as they come. Okay, all right. Let's not spend too much time on it. QQQ, same thing. There's your divergences. There's your all these resistance levels. The back uptrend line. There's a downtrend line there. Big level right here. Big resistance. And we popped to the upside 297. So I'm going to tell you now about 296 to 297 is big resistance and a near-term bounce target on QQQ. Along with this about 390-ish level, 389 to 390 on SPY. So those are resistance levels that are likely to come into play, and either hit them and get rejected, or you break out and that would be bullish. But again, careful today and or tomorrow. You tend to get a lot of whipsaws right after the Fed meeting. I don't want to spend a lot of time on it here, but this is a 5-minute chart of NQ. You zoom in real tight. You've got a downtrend line you can trade off of. Bullish have broken out, and then you have resistance above it, stuff like that. And then you have an uptrend line. So these two lines, just on the 5-minute, the downtrend line here and that uptrend line, they form a symmetrical triangle pattern. So bearish have broken to the downside, bullish have broken to the upside. But again, it's only a 5-minute chart. Then you want to look at things like you go back out to the 60-minute chart. Let's do a monthly. There it is. There's that same symmetrical triangle. So this is kind of what I'm watching for here today. Then there's that uptrend line like I showed you on the QQQ chart. You can see all my levels. 12. These are all levels I covered recently. I might have added one or two more lines since then. So those are all your potential targets and resistance levels that bullish have taken out, and bearish if we get rejected off of. And then down below, about 11,784. That's the recent lows. So you break the triangle, you break that, then watch those divergences may get taken out. So if it's anything more than just a marginal new low that undercuts those, runs the stops, extends the divergences, see, a lot can happen. And I'm throwing that out there. I always say this. Charts are dynamic, so is my analysis. But these are things to look for. All right, let's move on. We'll see. And of course, I'll do an update post-Fed. Bonds. Like I said, just it's my working strategy or theory right now on what's going to happen in the bond market here. But you look at TYX, this is the yield of the 30-year Treasury bond, and we've taken out, this is that secular bear market in interest rates that I've talked about when rates peaked back in the early 80s right there. Been moving down. These are all your rounds of quantitative easing. And then the nuclear option, but boy, it's quite a reversal. And that's what happens, especially when you start taking the juice away. And they overjuice things there. And we've actually taken out both the primary downtrend there, and I have an alternative trend line there. But I think it's a brief overshoot. Rarely you're going to go like this and continue to go straight up. If we continue at this rate for much longer, this I can all but promise you, we're talking complete annihilation of the U.S. and the global financial markets. They just cannot tolerate. We've been at low rates, too low for too long, and we're just now getting back to normal. So you look historically, are rates out of hand? No. Right now, the 30-year mortgage just got over 6%. That was the highest since 2008, since the last financial crisis, the last bear market. But at this point, the economy is absorbing this. It's an adjustment period, like the Fed warned it would be. But if we continue at this rate of ascent, this is a near vertical ascent here in interest rates. That's unsustainable. So I think the risk reward, and even 401k money and all that, if you want a tactical or strategic trade, more like move some money into bonds right now, because I think at best the rate of ascent is going to slow to stop, meaning we stall out here for a while, trade around there, and quite possible that the Fed is maybe overshot here. Because remember, I'm multifaceted. I look at commodities, DJP. I'm telling you, this is one of my real-time indicators. I know what's going on with the housing market as well. DJP has been, this is a broad-based commodity ETF. I'm sorry if you're new to the site. I've been covering this one as kind of a proxy for inflation. And so it's already down 23.5% off the highs, had a little snapback rally here, broke this wedge, and I still think it's coming down further at about at least 31 right there. That's my guess. And if that happens, that means an abatement of inflationary forces, and then bonds are going to start to look more attractive now that the yields are a lot higher than they were before. So now, here's the thing. The bond market and stock market have been rallying almost in lockstep, moving up and down. They've been trading positively correlated, which is unusual because historically, go back 100 years or more, they tend to move inversely, opposite one another. Okay, so will that relationship continue? In other words, if I'm right and bonds rally from here, will the stock market rally? And it's possible that we disconnect that finally, that you may see if we get that last leg down in the stock market to my final target, on QQQ and on the weekly chart. You could see that and see a disconnect. All of a sudden, institutions may deem bonds attractive at this level now that, you're paying, 3.5 or whatever on the 30-year and, 10-year bonds. So they may flock to that as a flight to safety instrument as they have done historically. They just haven't done it so far this year. But one thing, these are historical relationships will ultimately come back. In other words, in fact, when the dollar goes down, gold goes up. When stock market falls, bonds tend to rise. Those at some point that's going to return. Right now, the problem is the Fed has intervened in the natural process of price discovery in the financial markets by being the biggest buyer of treasuries and government bonds, and now the biggest seller. And so it's kind of turned everything topsy-turvy, upside down here. All right, so those are my thoughts, and let me just finish up on bonds. The way to make money in bonds is, they're a lot less volatile. So if you're trading ETFs like TLT is a 30-year bond, you need to use a lot more than you put into QQQ or SPY. So here's a weekly chart. This is what I wanted to point out. Negative divergence, bearish rising wedge, a beautiful uptrend line. That's beautiful. This is the 30-year bond yield. There's that long-term trend line. I believe this will be a momentum-fueled overshoot. We're going to break this, come on down, and there's a minimum drop right there for the 30-year minimum, back to about that's 2.9%. We're at about 3. You can see they're 3.5 right now, 3.5, and then step it down to a daily chart. This is a rising wedge. Remember, I'm covering the yields. Yields they are inverse to price. So when your bond yields go down, first break of that trend line would be your first sell signal. There's my BOD, or benefit of the doubt trend line. There's the first stop. And I think we could come all the way back down here to that 24.15. Let me show you the actual ETFs. Flip it around in reverse. TLT is the 30-year bond ETF. I've been highlighting for weeks now this descending price channel, very well defined, a lot of energy building there, big positive divergences. So whether we get it today with the Fed, it's probably going to be the catalyst if we get one, or maybe in the next week, maybe there's a final. There's certainly a possibility. We're in the channel. I've said it before and I'll say it again. This is only a trade setup until you get a breakout, a solid candle, a solid daily close above there. You're in a downtrend, make no mistake about it. These divergences can just continue to build. They may even peter out by the indicators going on to take out those previous lows. As of now, they're in place and they're strong, and nothing is more beautiful than a one-sided trade, meaning bonds have been toxic lately. I've been reading about institutions aren't buying. The only one buying bonds lately was pretty much nobody. They're going down. And with this Fed and everyone else selling. So you could see quite a bit of short coverage. And I'm sure that goes along without saying that there's probably a whole lot of short interest in there. And so, boom, get a quick pop. This was the previous trade right here. We had that downtrend line hit my final target there and got out. And there was this leg down. And I'll tell you that I think we'd probably go back up there again. So there's a sole target if you want just one target. And that would be in TLT, 12% gain. So using a 3-to-1 RR, you can give yourself a 4% stop loss if you wanted to get speculative and take it in anticipation of a breakout now. 4% downside with 12% upside is a 3-to-1 RR risk reward ratio. Very attractive in my opinion. Or wait for the breakout and then set your stops accordingly. TNX is a 10-year bond. They tend to move, the shorter you go in duration of the bond or maturities, the less volatility you tend to have. There's the 10-year right there. Same thing. This is a daily chart. There's your negative divergence. There's your minor. It's so well defined. So when that breaks, boom, you're going to see a pretty quick move down. Targets would be at least at 2660 in this uptrend line. That's a long-term trend line right here that comes off the COVID lows. Beautiful target. What I call a high probability target. Like, if in other words, what does that mean? You can short that, throw away the key with a stop in place, not even look till you hit that level. I would put good odds that it plays out like that. Nothing's 100%, but like I said, that's almost a magnet. If we get those really that sell signal there, this is minor support right there. And then of course you don't trade rates, you trade the bonds. That's IEF. That's the 10-year Treasury bond ETF, and there's that same tight price channel. I could sit here and I can cover the futures, but if you trade ZB, it's a 30-year bond future, ZN's a 10-year, ZF's a 5-year, but you already know that if you trade futures or bond futures. So, and you're going to see almost identical patterns there in the bond futures. These ETFs do a solid job. They track almost perfectly the price of the bonds. So that's it. And like I said, I'm not looking for a quick in and out trade. I'm looking for for a bond trade. That would be if you got 10% on the long bond, that'd be one of the best trades in a while. So all right, on to the other things. I can wrap this video up. I did an update for you on NG today, but I guess I'll do it now. Quick update here. Hold on one second. NG natural gas. This is that 1 hour chart I gave you today. Remember, I zoomed in to monthly candles. I'm sorry, hourly candles. That's what it looks like on when I go out 3 months. But this is pretty darn good support here. That's where we covered recently. Or I said you could cover a short because you had a bullish falling wedge pattern there at support with positive divergence. Really, it doesn't get much better than that for a bounce trade. I remain still longer term bearish, but I don't want to. If I can sidestep or even turn around and close a short and profit from a 10% bounce, yeah, why not? And so, you take a shot, and there's the breakout. It was impulsive. We moved up. And then, like I showed you this morning, we hit the back test of the trend line, the downtrend line. You had another trend line up here. But price resistance right there. That's where the arrow I had drawn the other day on Monday, where we'd go to that 8058 and come on down. So we still have to take out the recent lows, but what we did do today also, if you recycled back in there, it's nice. We took out that near-term uptrend line, and we took out this support level right there, although we're right about on it. So bigger picture remains. Go to 1 year chart, daily candles. This is a bigger picture. Never ever lose sight of the bigger picture, especially if you're swing or trend trading. That was our last uptrend line, aka bearish rising wedge with negative divergences, and that was a 45 or so % drop. We rallied up, put in another bearish rising wedge, a textbook one, beautiful. Negative divergences, sell signals, dual sell signals, trend line and that. We also had an earlier sell signal, I believe, right there. And this is it. That's how you work. That was the last time I made an objective add-on, short add-on, re-entry, new entry, swing it down here, and then we gained that little bounce. So now look, this is the big picture. 750 right there. We need to take that low out. I think it will happen, and then we hit my final swing target, which is down here and has been for the last month or two. It's about 654 and or the uptrend line, whichever comes first. They should come in around together. Roughly, they come in together right now. So, yep, that's that. And then crude oil, and then we'll wrap this thing up. Oh no, I want to do cryptos. I'll get it all out for you today. You'll watch this. You have plenty of time before the announcement today. Crude oil, short term there. Let me show you. Let me start big picture again for those new or just catching up. This is a pretty darn good support right there, in my opinion, on crude oil. And it's more of a support zone, but the line I have here is about 85.70. You can see that it was support back here, and it's been support for months. We've gone through it, little whipsaw to the upside, but we're still below it, and we're starting to move away from that. And once we take that out, like I said, there's been some positive divergence here, but I told you I suspect that'll play out. Even when we broke it, I said we may run back up there. This is them trying to shake you out. This is how it works. Whether it's natural forces or nefarious market forces, market makers, manipulators, doesn't matter. Right now, I still think crude's going lower here. Well, I don't know where. You know what? It was on the December contracts that I had the longer term targets. Let me do that one for you real quick. The Novembers are the most active, but I think I put this one out before. This was. The broker for these charting programs is showing this as the continuous. No, where did it go? Oh, you know what? It might have been before we rolled. All right. Either way, I think we're coming down here in crude to about 71 or so. Right there. I think that's probably where we're going to end up. And then near term. Oh, here, I know what I can show you, which has been constant. There's USO, the crude ETN, daily chart. There we go. There it is. All right. So there's that divergence. It's going to greatly help our case of hitting this final swing target right here, 58.60, and the uptrend line right there. You can see that uptrend line comes all the way back to March of 2021. If we can get burned through these divergences. So you can see here, there's that support zone on USO. We've been flirting with it. We haven't clearly taken it out yet. We went a little below it, popped back up, a little above it, back low, and here we are. So we need to undercut these lows. If so, we'll probably see those divergences peter out, and then get that final wash down to about 56.80 in the uptrend line. If this happens soon, that would or could help be the catalyst for that near-term rally in the stock market. I'm looking at one more tradable rally up if these 60-minute divergences play out with an abatement in especially crude oil and natural gas. If those two drop, that's going to, like I said, it should send bonds higher, because now it lets the Fed have some breathing room and they can back off, and everyone's going to say, oh, the Fed is doing a good job of stopping inflation. So right about the time everybody believes it, the stock market will rally, bonds will rally, and then crude and natural gas will hit our supports. Again, this is, I know it's a grand plan, but this is how I trade. We do that, and then we're going to be covering our shorts going long, and for the reflation trade, and that's when crude and natural gas hit those targets and start to rally hard off there, then that should start to bring stocks down and probably give us that final leg down in the market. All right, guys, I know that's a grand plan, lots of moving parts, but again, let's take it day by day, minute by minute, see what happens today. I'm not married to the fact the markets must bounce here and the 60-minute divergences must play out, but as of now, that's the way I'm leaning. And if and when I change my mind, I'll let you know. Crypto, and we'll wrap up. Ethereum, let me start out with the ETF type instruments. ETHE, this is Ethereum, Grayscale Ethereum Trust. So let's just focus on this little box here. This was what we call an island cluster bottom, island cluster reversal. You had a strong downtrend with a gap down, a gap separate on both sides. So this cluster of candlesticks, and that's a significant potential bottoming pattern. Now, you have to remain above it, and we are above it now. So if we can rally up here and especially take out the downtrend line, that's going to be powerful. That's going to be bullish for Ethereum. Keep in mind, cryptos and the stock market have rallied in almost perfect unison. They both topped around the beginning of the year, end of late last year. NASDAQ and crypto topped in November. S&P topping in early January, and they both been in a bear market since. So this is not 100% contingent on, but is largely contingent on the stock market rallying. Okay, so as I said it before, to be long in bullish crypto is to be long in bullish equities at this point in time, and until I see that disconnect, that's the trade. So the takeaway is, if you're short the Nasdaq 100 and you're short crypto, you have a concentrated position. The only difference is crypto tends to go up and down more in percentage terms than the stock market. So keep that in mind. So as of now, there's a potential to rally. 60-minute chart, positive divergence. This is Ethereum on the 60-minute chart. Look at that. Bullish divergence there, a little trend line I'm going to tweak right now. There you go. There's your nice, clean downtrend line, 60-minute bullish falling wedge, just like similar to the equity markets. Could get a nice rally here, and that's the way I'm leaning because of these 60-minute divergences and some support there as well on Ethereum. Bitcoin, GBTC. Look at that, nice. We had a trade back here. We had positive divergence right there. Hit first, second target. Never made it to my third, but it's really one in the same trade. If you entered back here, we're back there. This is big support here, about 1180. We'll call it about 1180, right where we are now. And this is a 60-minute chart, but you have, just like on the stock market, just like on Ethereum, you have positive, aka bullish divergence here on the 60-minute time frame. So we could be set up for a nice move. This is what it looks like on the daily chart. Had a little breakout here, hit that first resistance level, back test, but look, positive divergence on the daily on Bitcoin. And then finally, the futures. This is a 60-minute chart of BRR, Bitcoin futures. You have this downtrend line right here. Again, it had a little breakout pre-Fed, but I warned never take a breakout before right on the day of an FOMC meeting. It's most likely going to be a whipsaw. But if we can get a solid break here post FOMC, look, positive divergence on the 60-minute chart of BRR, and look at this, the same thing. Obviously, it's just the futures of what you were just looking at. 18,426, give or take. Look at how many reactions here. Boom, boom, boom. That's a 3-month chart. Let me see if I see anything different if I go to 6. Yeah, you can just see this is a big level. So either the market's crap out here, stock market, crypto, everything breaks support, heads on down, has that final washout move, or we can rally and then get it. That's the way I'm leaning now. But like I said, I'm ready to adjust and adapt if we break down and it looks like it's going to stick. And then on Ethereum futures, ETHU, that's a 3-month chart. Let me go to a 6-month, show you the 2-hour candles. And this is what it looks like on Ethereum futures. You had that basing pattern there, right? Remember, we had a breakaway gap, especially in the ETHE, rallied up, put in a divergent high, and that capped that rally right there. And we're back testing that. That's big support, because that was a major, very significant technical breakout. We came back tested it, and you've got pretty much a downtrend line there. So if we can pop that, that should be bullish for Ethereum. And if you break down, well, then you're back into this range here. Then the bottom of the range is really the final and last support. But from my experience, once you re-enter a trading range like this, you usually go all the way back down to the bottom. So you have to consider that if we enter the range and it's anything but a brief whipsaw, you're probably looking at about a 20% drop to that bottom of the range right there. All right, I'm going to wrap it up here. 35-minute video. We'll do that, and I'll do an update on gold and silver and the euro and all that. We'll do that after the FOMC meeting. Then we'll have a good. We should have a very good idea which way the dollar and the euro want to go after today. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.